Welcome back. This is Dan, and let's make millions. Today we're going to answer the big question of why invest in dividend stocks. And the short answer is math. But the real answer is long-term safety and trying to negate risk as much as possible. Many large and small companies offer dividends as a reward to investors for taking an interest in their company. You invest X amount of dollars and they give you back a small percentage every month or quarter. So why are dividend stocks better than other stocks? Well, I wouldn't say they're better. Okay, I'd say they're better. They're better. They're better because they can hugely negate risk, or at least some of it. For example, say there are two companies and you invest $100 in both. Let's say stock A has no dividend, and stock B has a 10% dividend. Over the next 12 years you hold these stocks, then suddenly a huge market crash hits and both of these companies go under. Sounds like you're out $200, but in reality you're not. On stock A you have most certainly lost everything, but stock B has been earning you money all along. In fact, it will have earned you more money over the 12 years than your initial investment of $100 in that stock. So in reality, not only will that stock have covered 100% of its own losses, but it will have covered another 20% lost by stock A. This ability to make up potential loss is what makes dividend investing so attractive to people. Another big part of dividend investing is compounding your investment. By reinvesting your dividends, you can make exponentially more money in the long run. Let's use Enbridge as an example. At recording, Enbridge is yielding 8.51%. Now, luckily, you were given $1,000 from old Pappy on your birthday and are ready to invest. With $1,000, you buy your shares of Enbridge. You enjoy holding it for 10 years. Every quarter, they pay you out $21.28, and you throw it into a little jar on your nightstand. After your 10 years are up, your little jar has a nice $851.20 in it, plus the $1,000 worth of stock you still own, which is $1,851. That's awesome, right? Well, let's see the difference if you'd done the same thing, but instead of throwing your quarterly payments in a jar, you kept buying more Enbridge stock. After 10 years, that $1,000 would now be $2,321.18. That's an extra $469 more. Therein lies the power of reinvesting your earnings. This doesn't take into account stock price shifts, etc., but it can be a good visual for why dividend reinvesting can be so powerful. Want to get started and need some good stocks to start with? Then check out some of our other videos. Also like, subscribe, and comment with any ideas for videos you'd like to see in the future. As always, this has been Dan. Thanks for watching, and stay smart.